Bond investors will be listening in, waiting for more clues about interest rates from Ben Bernanke's second day of congressional testimony. Treasuries have been lowered to little change. 30-year bonds actually fell for the first time in 3 days today before Bernanke resumed his testimony. So will investors get more clarity on the Fed's exit strategy? How does that factor in to any fixed income play right now? To get answers, we're going to go to Stuart Spodek. He's head of U.S. fixed income for BlackRock Advisors. He joins us now from their office in Midtown Manhattan. Good morning to you, Stuart. After having listened in yesterday to the first day of testimony from Bernanke, did he put those inflation concerns to rest? And does day two really matter for you?
I don't think day two matters so much. I think yesterday Mr. Bernanke tried to really reassure markets that they understand the implications of the policies put in place and the importance of having an exit strategy. So I think they clearly have thought about an exit strategy. They think he also mentioned that it's certainly too early to exit. So I think the point is we're thinking about it. We know it's important. Let's reassure investors. Let's really try and anchor inflation expectations and make sure the market understands that we're not going to let this get out of control.
Not going to let this get out of control. So for you, and for the people you work with, what does this testimony, what is the broader strategy, exit strategy, albeit without time frame, mean for your trading portfolio right now?
Well, I think, the important things that I took away from his testimony yesterday, and I expect we'll hear similar things today, is that they still see potential downside risk to growth, and he specifically highlighted risk to the household. So the U.S. household has suffered clearly from a decline in home prices, today uncertainty with respect to home price, as well as uncertainty with respect to the labor situation and the income situation, and all of that does pose a potentially strong headwind to growth still. So there's still a lot of downside potential, and I think the Fed's trying to take steps to address that, and his reference to keeping rates low for an extended period, try and do that. And he made that statement a number of times, both in his statement yesterday as well as in the Wall Street Journal piece. So I think that was important. His comments with respect to exit, I think, really served to try and anchor inflation expectations and reduce volatility of long rates. Now, the Fed can't do that alone, and I think he squarely highlighted that by placing some of the burden for that on fiscal responsibility from Congress.
Right. So what do you buy, and where do you buy it in the yield curve?
You buy, 2s through 5s. He basically said they're going to be in hold for a long time. The Fed's not going to tighten. You buy, 2 through 5 year treasuries. You buy high-quality spread assets, and you try and, over time, probably reduce some risk asset allocations.
Some comments out of China today in regard to maybe spending some of the reserves that they have on actual assets, on investments outside of just the treasuries that they have collected so much of. Any thoughts on whether the broader global picture when it comes to tick data is going to factor in here to your strategy? It's clearly going to have an impact. International demand for treasuries and for U.S. assets has obviously over the years been quite strong. We expect to see continued good demand for treasuries. Clearly, you would expect that many of the large dollar holders outside of the U.S. will over time continue to diversify their holdings. They have been doing that. The flip side is you'll see increased savings from the U.S. household, and they'll be able to put that money to work in the U.S. market. All right, Stuart, thank you so much for joining us today.
Thank you, Mark.